Hello, everybody. Welcome to this session about options trading. My name is Yannis and I'm here to talk about the three most distinctive strategies that I use in order to provide income and generate returns, which are not really correlated to what the market is doing. Now, allow me to talk about myself for exactly a minute or less, and then we jump on straight away. So who is Yannis? Well, I've got 23 years in the markets. I studied in Spain, in Madrid and Birmingham, did my master's. I'm in the portfolio management business, also client consultation. And I've been invited to several events abroad. The next one being in Dubai these days and moderating panels for different entities such as Bloomberg and expos around the world. Co-founder of Spanish Traders Magazine, which is a renowned magazine, which used to be also in English language quite a few years ago. Father of three and a keen pianist, obviously as an amateur in my free time. Contact details and English mobile here and a Greek one, as well as my YouTube, in case you wanted at the end of the seminar to know more about me. That's pretty much what I wanted to talk about me. Now, options, I'm not going to dive into the bits and pieces of options pricing and model and how they are, really priced in terms of the option chain and all that. I don't want to use terminology, which is, will sound like Greek to you, but I want to show you just the three positions that you can actually apply and talk about 1 minute about my seminar at the end, if you allow me. Anyway, this is a recorded video. You can pause anytime you'd like. So what are options? Well, we know it's a right to exercise, buy or sell the underlying at a given price and within a given time frame. So everything starts and ends with a time component of options, right? So something you don't have with stocks, which you can buy and die with it. You need an expiration date with options, right? So typically they expire about the third Friday of every month. So next month, for example, in this cycle in March, expiration date falls on the 18th of March. In April, it would be the third Friday of April and so on. That doesn't mean you don't have options which expire weekly, on a weekly basis, which is why we call them weeklies, or even longer term ones. We typically choose between 1 week and 6 months of expiration. I personally work with the 30 to 40 days of expirations, and I'm going to show you exactly why. So first and foremost, options are rights to buy or sell an underlying. They can also be an obligation. We'll see that. And they have a specific way in which they are constructed that allows them to behave in a certain way as time goes by, which is why the time element is really important. So now that I mentioned that, let me start. I'm only going to use the flip chart, which I really like. And let me chart here an options value, right? And time. So that you can see how time affects really not only the value of the option, but the degree of decline in its price. So say we've got here 120 days until expiration. So if we are in February, today will be June, right? And then 90 days, 60 days, 30 days, and then 0, which is today. All right. So it's not really visible in the graph. So what it is, if I choose an option which expires, because no matter when it expires, I can also buy and sell every minute until expiration. That doesn't matter that I cannot do my trading. What it does matter is how the time value will affect the options price. And so if you start here today, February, and you buy a June expiration option, when 30 days lapse, you've lost just a tiny bit. All else equal, markets will remain the same, volatility the same, everything the same, just time goes by. After 30 days, your option will have lost value equivalent to this amount here. So not really a lot, right? So then we go like 60 days before expiration, and you can see, if I had drawn that a little bit more correctly, that this is a little bit more in terms of loss of value, right? The interesting stuff starts when you go like 30 days. So you can see, compare this distance with this distance, you can see it's more than double. So when you approach 30 days towards expiration, because these instruments are constructed in a way that they lose value as time goes by, to paraphrase the song, then you've got an advantage which you can use, or it can be a disadvantage if you don't know how to use it. So you see, if we are like in end of May here, and we had a June option, then we are approaching really, really fast the part where this curve really starts to lose value exponentially, right? And then come June until expiration, you are in this segment, the last 30 days. This is where the options value erodes the most. So they lose dollars from the premium you collect upfront, because that's what it is about. You collect a premium or you pay a premium, which really erodes as time goes by. So you need to understand, or what we call it, options are wasting assets, right? Why do we call them like that? Because they lose value no matter what, okay? So let's go to the first mistake that people make, because options is not like going on the web and read something about it and then, yoo-hoo, let's start trading. It's not really like that. Why? Well, let's give an example on Apple, right? So you've got an Apple stock and you got an Apple call option. Now, funny names they used to call options, like call options and put options. Basically, we need a jargon to be able to communicate between us traders and investors. It's like you hire a boat and then you've got terminology there. Instead of long phrases, you use a very short one. So that's what it is. So you learn 20 words and that's what it is. Don't get intimidated by like a new terminology, okay? So let's take a look at the most common mistake that people do when they start trading into options. They find the magic of leverage, which is what it is about, and they find the magic of controlled risk. So remember, options are wasting assets. They lose money until expiration, but not at the same rate. It gets more exponential here at the end, between 30 and 40 days before the end. You can always trade them, you can always close or open a position, and that's the most common mistake here that I would write. So say you're buying 100 Apple shares, which today costs about $170. So you've got a $70,000 which you need to pay, right? So this is a cash position. You pay 100% for the 100 shares, right? And say Apple goes up by 10%, which means it goes to $187, which goes to show me that you made $17, correct, per share, which multiplied by 100, the number of shares you have. So you just made $1,700. Kudos for you. Now, what that means is like the return on investment, how much money you made on the money you deposited, is what? 10%, right? So far, so good. Now, the average portfolio of people who actually deal in the markets might not be like 50 or 100K. You might be more like 10, 20, 35, depending on everyone's portfolio. So that position might actually exclude you from buying the spot price. And then people say, all right, there is an option. There's a contract, a product, which is called call option. What does it mean? Like, I make money when the underlying that I chose goes up. So let's see an example. One thing you need to know, that any option is equal to 100 shares, whether be it ETF or shares. So when I buy one option or sell one option on any underlying, an underlying cannot just be a share, right? It can be crypto, it can be an index, a share, and many, many other things, from acidity of oranges to carbon emissions, okay? And even lately, I think water. NASDAQ has done a contract on water. So 100 shares, so that's what we call it, the contract size, all right? So any result has to be calculated by 100, which is exactly what it is here. So say you buy 170 strike price call today. So what it is, like, don't get intimidated. What is the strike price? What's the price at which I'm willing to buy shares of Apple, which is 170. But I don't buy the shares directly. I buy the right to buy the shares. And when do I exercise the right? Where these shares go up, which in fact, they have gone up by 10%. They have gone up to 127.87, I'm sorry, which means I too made $70, which means if I multiply by 100, because one option is equal to 100 shares, then I too made $1,700 like you. The difference here is that my return on investment is not 10%, is how much? A little bit over 100%, right? And you can see the effect of leverage. Why is it more than 100%? Because I only deposited, I'm sorry, I didn't say that. Sorry, the cost of this option is $8, right? Which is basically $800. Why? Because you multiply by 100, because it's the contract size. So that's the premium, right? Like the insurance premium that you buy to protect your house, your car. What's the same here? Only here is not protection. This is speculation. So you want Apple to go up. They call this product a call option. It costs $8. You multiply by the contract size. One option is always equal to 100 shares, and you paid $800. So you paid $800 instead of $17,000 at expiration, because before that many things can happen, but for now we just study the at expiration graphs. And you paid $800 at expiration. You made $1,700, difference between where you bought it and where here is the stock. And then you made 100%, more than 100% on your investment. And that's what people really like. But guess what? 91%, when people buy that, lose money. And they fall into this bloody rule, which I like to call 90-90-90 rule, meaning just like that newbies or even semi-experienced investors would lose 90% of them, would lose 90% of their money in just 90 days. Why? Because this brings memories of lottery. That's not trading, gentlemen. That's lottery. Why is it lottery? Because in between, what happens? Time effects. Very rarely you will get Apple to give you the maximum of the move within the 1 month or 40 days that you want. And if you choose more, well, options value will not erode, but you will pay much more. Why? Because of the time value of money. €1 today is not the same as €1 in 4 months, right? So why does Apple or any other instrument whatsoever does not really make you do you a favor to just go $17 up within 3 months? Because more often than not, shares, ETFs, indices, or any other underlying is what we call mean reverting instruments, right? So Apple doesn't go like that from 170 to 187. It goes like that. So up and down, up, down, prices up and down. What does that mean? It's mean reverting. It's reverting to its mean, exaggerates, comes back, exaggerates on the other side, and then wave up, wave down, wave up, wave down, and it goes like, if it goes, it might take it 3 months. So if you remember, like 7 months ago, about September, October time, Apple was trading between 119, 140. 119, 140. That took it about 3.5 months, 4 months to break the 140 plus and then just shoot to 170. Fell 150 plus, again 170. Long story short, that's what financial instruments do. They fluctuate around the average, right? The arithmetic average, and then or mean, better said, and then they just go up. So that's why this brings lottery memories. You don't buy outright options. Why? Because time is against you. So if time is against me, what do I need to do? Well, I just need to sell, take the other side. And let's take a look of what happens when I sell options. So let me show you really why statistics is something that we can use right? So you know the American casino, they've got the 2 zeros and 1 0. I don't want to make a parallelism between casino and markets because they're not, but it's a good idea to have in mind. So when you are the client, you're just trading against the casino, and you almost always lose because the law of big numbers and probabilities, casino will always have because of these 2 zeros and 1 0, they will always have the probability on this side. That would mean, if I recall, that's 5.4%. So for every million traded, they will make 5.4%. They will never take a directional bet. They will always sit down there and wait for you to trade. And once many people trade many times, the law of large numbers will just bring it to where it should be. 5.4% guaranteed returns for the casino. So we want to be the casino. We don't want to be the clients. And the way we do that is we can't trade directionally. If we just think Apple would go from 170 to 187, that makes you no different than any other trader out there who actually trades the spot market, uses technical analysis and just about that, and then prays to God that it goes up. Up, win, down, lose. But that's not trading, right? That's not speculation. This is like luck. And maybe some people would argue, well, not really luck, so technical analysis works and my risk management works and everything. Yes, but it's still directional. It's a binary bet. Up, you win, down, you lose, right? So what options do for you is they can actually give you 4 out of 5 scenarios where you can make money, and just one scenario where either you lose or you just don't make that much money. Isn't that better? Like, we've gone through Ukrainian crisis, because this video is like being recorded in mid-February 2022. So we've got Ukraine just ready to unleash the army. You've got inflation monster, like inflation largest in I don't know how many years, at least 3 decades. And you've got Omicron COVID at least behind us. You've got all this crap, markets going down 12%, 15%. You would find that strategies that I'm going to show you right now actually are bulletproof, and there is one scenario that will not make you that much money, but that's not too bad, because portfolio protection and risk management is really the key. Otherwise, you're just like the rest of investors who view this market as a binary bet, whether they like it or not, right? So the first one is called a cover call. Cover, why? Because I own the shares, and I'm going to show you now what exactly is a cover call. So say Apple shares do trade at $170, right? Let's see why a cover call position is superior to just buying outright a stock. So buying outright a stock will actually show like that. That's how it is graphed. Don't matter why this graph and what does call mean. It doesn't matter. All it matters is for you to understand for now that the combination of a stock and an option is really always, or almost always, much better than just outright stock. Everything works, your diversification, your technical analysis, fundamental analysis, yeah. And in the long run, I guess you can make money, but also Keynes said that in the long run, we are all dead. So depends how long run is this long run. So keeping your portfolio in a medium to long term, whatever that is, 1 year, 5 years, it's perfect. In the meantime, there is statistical noise which creates volatility unnecessary for your portfolios, could make you lose a lot of money. Facebook is like 40% down. Netflix is like 40% down. They go up and down like crazy. How can you make money or protect yourself from that? Well, you know what I say? All I care is I don't want a stock to fall below a certain price. I just can't predict if Facebook will be $300 again anytime soon. It might be, but it might take it 6 months. And in between, I can protect myself and do the risk management like professionals do. I've had the luck and honor to be working at the trading room in City. I lived in London for like 9 years. And I've been working in the industry of CFD, the likes of CMC Markets and FX Pro, and then Citibank, being a stint there at the FX structured products options. And that's really what made me understand that, like, A place with 952 traders on the second floor in Canary Wharf is like 100 billions and billions of euros every day in transactions. And the only way they do that is like not taking directional bets. When you buy something, you got to sell something. That's what I learned there, which means hedge your position, no matter what. When you realize you need the hedge, it's already too expensive and it's useless. So when you buy something, please sell something. And that's what the options do for you. And also pay nothing for something. Like when we buy Apple share, I'm just trying to find an idea, a solution, how to bring this cost down. I mean, there are ways to bring this cost down. And if 4 out of 5 scenarios are really good for me, then that's a good trade. That's not a directional trade. And I'm not doing something that 99% of retail investors are doing out there. So let me sell 182 call option, which for the sake of the argument, it appears like that. Okay, so what does it mean? I'm not going into that, but what it really means is that when you sell a call option, you are selling the right to buy. Okay, it might get confusing, but we don't care for now. All you care is understand that below 182, which is the strike price of the sold call, you keep all the premium. Let's say it's $2 you get. You get a premium. When you sell something, you get a premium. Besides, you see that on the positive axis, right? So you get a premium. You don't buy. You get remunerated for leveraging your portfolio, right? So you get a premium, which you actually want to keep in your pocket. You just cannot spend it at the beginning, at the outset of the agreement you have. But as time goes by, options are wasting assets. This will go to zero. So because assets are mean reverting and Apple might be going like this, at the end, as long as it finishes below 182, you make all this premium, right? And I'm not predicting. So let's see some scenarios and draw, first of all, this red line here, because really you will see what I've done is actually I've lowered my Apple position in $168, right? So that's why they call it a financial engineering, the options, because you're actually working with what market gives you and playing it a little bit smarter than the average investor, I would dare to say. So 177, say Apple has gone up, right? Apple has gone up. You made $7 because you own the stock, right? Well, I make $7 because I own the stock too. That's why it's called cover call. I own the stock and I sell, oops, sorry about that. Sell a call on that, okay? Make sure it's working, okay. So you made 7, I made 7, but guess what? It's below 182 at the end of the expiration. Say this is 18th of March. So I also made $2. It's not $2, right? It's actually $200 because I multiply always by 100. That's the contract size. But for the sake of the argument, it's $2 so that I can find my equilibrium and break-even points. So there's one scenario. Apple goes up a little bit. I make money from stock. You make money from stock. I make money also from the options wasting value. Say Apple prices a little bit more and goes to 182, exactly where I sold the call option. You make $12. I make $12 from the stock, right? But I also make the $2 because the stock is really on the $182, which is my strike price. So I tend to keep all of it. So Apple doesn't go anywhere, goes up and down, and at the end finishes on the price where we bought the stock. You make no money from the stock. I make no money from the stock, but I do make $2 from the option because it's still below 182. Same story goes, if it falls by $2, you lose $2 from the stock, I lose $2 from the stock, but I made $2 from the call, so here I'm zero. Bottom line, every time I will be $2 better than you, and that's like free money, really. Now, there are some conditions whether volatility is high or low, or whether market is really trading towards up, but in general, you would be better off selling calls on a position you hold And obviously there is the nitty-gritties to discuss, but the general idea is that the only scenario which you could not lose, how we call that? This point on, we call it opportunity cost of capital. That's not losing. That's not making the money that you could have made, but you still make money. Why? Stock has gone from 170 to 184. This is 184, right? Just adding the cost. That's my break-even point. Stock goes up, you make $14. I make $14, but I don't make the two. So here, I'm like the same with you, right? But when it goes up, you make money from the stock. I make money from the stock, but I lose the equivalent money from the call option here. Until expiration, this loss will be exactly compared to this profit. So here, I'm 100% hedged. So I can't make more than $14 on my Apple stock. So that's called opportunity cost of capital. I'm not losing. So what's the problem? Close this position, get your money, open another one, next month's expiration. This is like stable, I make more money. Falls a little bit, I make more money. Goes up a little bit, goes up to a strike price. 4 out of 5 scenarios, I make more money than you. The only way that this will not work is really when the market goes like crazy, say in the post-COVID area where everything goes up like 10% every day for months. Okay, that will not work because you've got a very fast market. How many times, how often does that happen? Normally after a black swan event like COVID or such as COVID, right? So under normal circumstances, you would be better off selling a call option under this example. Why? Because the premium really gets into your pocket eventually. So let's find out what our friend Warren Buffett does. And don't get me wrong, I like the old guy. He says he doesn't like options, they're weapons of mass destruction, but I think he's the biggest liar. Why? Because he actually does this every single time he can, right? So what is that? And let me write here cash secured, which is what he does. Now, not like because Warren does it, we do it, everybody does it. It's just not everybody knows how to do it. So Apple, excellent. I like Apple, 170. I know, I'm not really sure. Now, that's not like an opinion, right? I'm just saying, like, as an example, maybe you're not really sure Apple is going to be shoot through the roof at 200, and you really want to buy Apple, but you want to buy it at the mean reversion, right? Which is more or less around, say, 155. So you want Apple, but it will be better that you bought it at $155. But Apple is trading 170. Under normal circumstances, not knowing options, what do? You just place a buy limit order, right? Buy limit order for 155. It doesn't cost you anything. Apple goes up, you don't buy it, that's fine. It didn't cost you anything. Apple goes down, you buy it, okay. But I've got a better solution. What do? You sell a put option, a strike price of 155. Why? Because selling provides what? Income. Another $2, which is actually 200, right? So what does it mean? Well, I get $2. I get remunerated by the market to take a stance against Apple, but that's not a directional stance. Why? Say Apple 170 goes to 180, right? I get to keep all the $2 because in this situation where you are selling a put option, when you are selling the right to sell, it doesn't matter. Don't get confused about terminology. What does it mean? You want Apple to stay above $155 on expiration, right? So 18th of March. In between, you might do crazy things. Volatility will affect this position. But at the end of the day, if it finishes above 155, you get to keep 100% of these premiums, right? So one option equal to 100 shares. For every 100 shares of Apple you own or you don't own, one option will be the equivalent. Now, there are two things on this scenario. Say Apple goes to 160, you still make money. You still make all of it. If Apple goes eventually, you do that 1 month, you get $2. Another month, another $2. Third month, another $2. And then eventually fourth month, Apple does go at 147, which means, well, it's gone below your break-even point, that you have to buy Apple. That's what it means, at 155. You have to buy, right? So the other side wants to sell it at 155. You have to buy, while Apple plays here the story of 147. But what does it mean? Well, in the meantime, you made 3 rounds of $2. So effectively, Apple now, you made $6 on the share. It's 149. It's closer. And you know what? You buy the shares here, right? Bigger portfolios, right? When you buy the shares, that's when it's called cash secured put, because you've got the cash to buy the shares. So if you want the shares and you have the cash, you don't want to buy them at 170, you just sell put options at a strike below the existing price. If market falls, great. I wanted the shares. I wanted here. I'm not like no magic. I can't read the crystal ball and know that it will land here. I wanted it here. In between, I made 2, 3 or more rounds of premium and I pocketed the money. So eventually I lower my stock acquisition price. Pay nothing for something, right? So try to reduce your costs. It's not like averaging down, reducing your costs. Sometimes it might work in bull markets, but most of the times it doesn't. Having a VWAP like adding, it's called the moyenne, right? So if this is without cash secured, you don't have the cash in your account, it's riskier, I understand. That's another story. But if it finishes above 155, then you made all the premium. If it doesn't, then you are obliged to buy the stocks, the shares, you don't have them, so you face this loss. Eventually, this is a maximum and infinite loss that you have. So yes, you need to be careful. Yes, it's not for everyone, but bigger portfolios who wish to buy stocks, which they don't want to buy now, but at a later date, they use it very, very often, and then you make money along the way. So that's called a cash secured put, and it's a very good way. Again, we're not playing the market directionally. I don't want Apple to go up or down. I don't care where Apple will go. If it falls a little bit, I make money. If it falls 10%, I make money. Goes up a little bit, make money. Goes up a lot, I make money. And that's what has been happening during this month or so of volatility. Stocks have gone up and down, but they make like a 10% range. No, so not like the Facebook and Netflix. You don't choose high beta stock, high volatility stock. You choose stocks which have rich cash flow in the account. They don't own money. They don't have debt. They had earnings last year and they're like mega caps, right? So these are the stocks, not so much volatility, that you could go on and profit. Stocks like Home Depot, MasterCard, Visa, JP Morgan, Goldman Sachs, Best Buy, ETFs of energy, materials, and the list goes on. You don't need to go to the likes of Facebook. And let's take a look at the third strategy that I'm talking about. And that will be what we call a bull put spread. Okay? Funny names, right? So a bull put spread is really a combination of what we just spoke. So our graph and a bull put spread as well. So say we wanted Kroger. Kroger is the largest supermarket chain in the US. A symbol is KR, and they've got a fantastic graph. Around $50, it made a move towards $40. An analyst from an investment bank thought that they wouldn't sell too much because people would just rush out, dining out in restaurants, like fed up with COVID, but that's not how really it works. But then again, that's what the markets are all about. It's all about psychology and in between what we call statistical noise, the volatility, right? So the premium you pay for higher returns is the interim volatility. So Kroger was trading at 50. So I come and say, I like this stock, but really I don't want to buy it. I don't know what's going to happen with power, with Fed, I'm sorry, and rates going up and how fast they will go up and all that. So I just need to take a stance that Kroger will not fall below a certain point. That's much like the short put example I did before. So $45 is what I choose, and then I sell a put option, like the one I just showed you. But stock is trading really at 50, right? So what do? I just give it a little bit of air to breathe, and I just go to a strike, to the price where I would like to buy the stock. We really don't want to buy. What I really want is to speculate in a very efficient way. So I give the stock room to breathe, and actually it can fall by 10% and I can still make my money. Why? Because that thing really costs $1.78, right? Expiration of March, for example. It was February expiration, by the way. $178. I take $170 because I multiply by 100. But I don't have the cash. I don't want to have the cash, but I don't want the excessive risk that comes with it. So what do? I go to 40 and actually make my protection, which is what it looks like. That's a long put option. Don't mind, it's your protection. It's the premium you pay to an insurance to protect your house. What it comes down to is this red line. That's what it looks like, a bull put spread. Now, you can go along on the internet, find out what a bull put spread is. It doesn't matter. It won't make you richer in knowledge. I think you just need to understand the risks involved. So what it means? Well, I buy something, so I paid something. How much did I pay? 0.45 cents to the dollar. That means $45. So what is my net income on that? Well, it's the difference between that, and actually is 1.33, which means $133 per combination, per spread, as we call it. Why on earth they call it bull put spread, I've got no idea. But when we say bull put spread, we always know that we sell a put option and we buy one for protection. That's what it is. Right? Buy something when you sell something, remember. So what does it mean? I'm not going to show you the payoff and everything, but if Kroger goes up to 60, how much money do I make? All of it. Why? I lose all of that, but I make all of that. And it's always the difference. So you always take a look at that, 133. So stock goes up, I make 133. Kroger goes down to 46. How much do you think I make? 133. Why? Because it's until expiration. In between, you might be losing because of volatility, but at expiration, and that's a hedged position, you will make money as long as Kroger remains above the 45 strike that you chose, right? Which actually did. Okay, so anything above 45, you do money. So stays here, you make all of it. Goes up, you make all of it. Falls by 10%, you make all of it. Name one product where it can fall by 10% and still make you 100% of the money you got as an income. And what do you take advantage of? I take advantage of the time. Options are wasting assets. They lose value as time goes by, right? So it's not like a directional bet. It's like every day that passes, even though this might fall, you make money from time going by, okay? So that's my break-even point, right? You just deduct this 133 from 46, say your break-even point is 44.67, right? Yeah, 43.67. Okay, 43.67. It's risk management that really matters, because when everything goes well, that's perfect. What it doesn't. Now, this trade here normally has 85% of probability to make money. That's what it is. It has 85% of probability to make money because it's got 4 out of 5 scenarios that will make you money. 1, stay where it is. 2 is fall, but no more than 10%. 3 is go up. 4, go up a lot. And even the 5th one, why? Because you don't lose here. You just give away your premium. You only lose when it goes below the break-even point, right? So what this will have, it will have a risk-reward ratio, which is gonna be roughly 1 to 10, meaning that if you are risking making $133 per contract, you will lose 10 times that, 1,300. Oh gosh. People get flabbergasted. They say, like, you crazy? Like, no, I'm not crazy. Why? Because 8.5 times out of 10, you will make money. Now, we never let this go to the losing position. Why? Because there are 2 risk management tools you can do. One, when stock goes around here only towards the end, right? Like a week before expiration. Why not 3 weeks before expiration? Because there is still too much time in there. I don't care if Kroger goes to 40, which in fact, it did go to 40 with this guy's recommendation, right? It did go to 40. Check out the graph, right? It did go to $40 and then stayed there for a couple of days and then started little by little. Within a week, it was going up, but the option value was losing because a week was passing by. Stock was going up, the week was passing by, time value was going down, and then this 133 was really going towards 0. Well, for the history, we sold that at 20 cents. Okay, so we made 90% of that. Well, that's how much you make. When you do make, you make 90%. What is your hit rate? 85%. 85% of the times, that makes money. Why? Because stocks are mean reverting and they lose money as time goes by. So even if that falls, I still make money. What happens if it falls more? Well, about a week before that, I actually roll these to the next month. It gives me more time, close this, make another premium for the next month. It gives me more time and it gives the stock time to breathe. But if you have a stock with very solid financials, a charting like aspect which you think it works, and if markets are really, well, we're not in a bearish market, then this will pay most often than not. And the strike price is not really chosen by luck. You know why it's chosen? Well, if you go to the Gaussian bell-shaped distribution curve, well, it's not Gauss who invented that, but he really made it better. So what it means, like you've got the Greek letter mi, which is the mean, and you've got the risk of deviating from this mean, which is Greek letter sigma, which is the standard deviation. Just a little bit of statistics. What is the standard deviation? Well, really the square root of the variance. So for those of you who are a little bit versed towards maths, you can understand that standard deviation really gives you the risk of deviating from the mean. And how much is that? Well, one standard deviation is really 68% of the occurrences, either upside or downside. You go 2 standard deviations is 95%, 3 standard deviations, 99%. You will understand it better when you go to a college. For example, you go to Imperial College and you say, okay, how many students here do you have around the mean? The mean is, for the average male, for example, 182, say, right? So you will have people that have 175, well, you do it in inches or feet or whatever, but like centimeters. And you will have people like 210 and play basketball, and you got people in between 150 and 230, so dwarfs and giants. You've got 99.9% of the sample falling. You close the sample, you go 95%. Here you've got people in between 162 and 205. That's perfect. 95 of the student percent will be with those. But if you close that, you go to 68%, then that means the sample actually studies people here are, I don't know, 179, 199. Not all of them will be, but 68% will be. That's one standard deviation. That's the 45 against the 50. And there is a way to calculate the one standard deviation. I don't want to burden you with too much statistics, but that's how it is calculated. And also markets, especially after the Black Monday, I'm sorry, in 1987, they just don't behave rationally. They do think, they do attribute a bigger risk that the market will fall than the risk that the market will go up. In other words, it's not a uniformly distributed risk profile. You've got bigger risk on the downside than a risk on the upside. And that again is only for stocks. It does depend because, for example, on wheat or on gold, you actually have a bigger risk on upside because they've got the scarcity factor and all that. So there are bits and pieces that you need to take into account, just so because you want to really, really make the difference. But even if I don't burden you with these statistics and how I get the prices and place my exercise prices, you just need to understand that because time value goes by, erodes your options price, even if it falls by 10%, you still make money, which it did, and we made 100%. Continues to fall, you've got another choice. What? Move out in time and down in price. So I just don't have the $45, I've got the 40. And then I move everything towards the downside to give even more room for the stock to breathe. 1 month it went down, second month it went down. At the end, it continues to fall. We made a mistake. It's in the 15% chance. Perfect. I don't care. What do we do? Two things. You don't have the money. Below the new strike price, 3% stop loss. Period. You got to take the hit. If you do have the money, I really don't like to have to take the hit. What do? I buy the shares, one option for every 100 shares. If I have the money, keep the shares. And what do? Start selling call options. So I turn this bull put position into a cover call position because eventually, as shares are mean reverting assets, they will go up from 50. If it goes to 35, it will go back up to 45 in a matter of 1, 2, 3 months. Along these 2 or 3 months, I keep earning premium by selling calls. And at the end, you will make money. So it depends how big your portfolio is, how risk averse you are, but at the end of the day, you've got 3 strategies which help me make up to 85% on the money I invest. Obviously, it's not like I have $200,000 and everything goes into options. That's also a mistake because when risks come, you have to always be prepared. But for the amount of money you really use to trade options, you could make potentially up to 85%. Why? Because you do keep 85 or 90% of the premium you make. Why? Because stocks 85% of the times will never touch your exercise price. And then they just die a slow death. And that's pretty much it. So stress-free, you don't have to be in front of your computer screen, stuck in between graphs, 17 screens and watch the markets all day. No, you just open a position on a given day and then wait for the time to do its miracle. What happens in between, it's called statistical noise. And if you've chosen correctly, what stop you would do, what price you would do, what exercise price you would choose, and how to manage it and when, then you actually have 4 out of 5 scenarios better for you. Now, isn't that a beauty? Isn't that different than what the average retail investor is doing out there? It doesn't need to be like a mega portfolio for you to do these things. You can even start low. These are the things that I do discuss in very, very much detail in my seminar, information of which you can find on my 2 websites that you had at the beginning of this presentation. Thank you very much for you watching, and I wish you all the best with your trading experiences. Take care.